Welcome to Barchart's series of webinars designed to educate you about a variety of market concepts, to inform you of the features and tools Barchart provides related to these concepts, and finally offer you some trader's insight to help you make a more informed investment decision. Today's session, stock market opportunities in 2023, a new year, a fresh start. So first of all, let me say Happy New Year and happy returns to all of those who are attending today. And as the year 2023 opens, we as traders or investors should take a moment to reflect upon the lessons that we've learned from last year's price action and an opportunity for us to, let's say, lick our wounds and chalk up our winners and identify the trends that have dominated 2022, which of those will carry through and which have run their course. Now, it doesn't take a rocket scientist to recognize that the broader indexes are in a downtrend, bear market, and that is defined by a series of lower highs and lower lows as price continues to stay below two downtrending sloping moving averages. The question remains, where do we go from here? And what trends will remain emerging? But how do we position ourselves or our portfolio for this coming year? Hello, everyone. My name is John Rowland, Barchart's Senior Market Strategist. And in the coming year, my estimate will be that this will be one of the most difficult years to manage investment. Just because there is so much uncertainty moving forward, and there are many unanswered questions. And these are two things that the stock market hates. But I think with a little bit of detective work and reliance on listening to what the market is telling us and not telling the market what it should be doing, I think we can find a clear path to opportunities and hopefully profitability. Now, before we get to that, please welcome my partner and our moderator, Barchart's Project Director, Gene Baker. Happy New Year, Gene.
Happy New Year, John, and Happy New Year to everybody out there in the audience today.
So, Gene, I wanted to say to you is, I know this is hard to believe, but do you know what today is in terms of our sessions?
Yes, I do. But why don't you be the one to break the news to everybody? Because this is pretty momentous.
I think it is historic.
It is.
This is Gene and I's 100th episode. So thank you, Gene. Congratulations. I'm really excited that we've reached this milestone, and I'm really looking forward to the next 100 sessions.
Yeah, thank you, John, too. I thought for a moment you were going to say the next 100 years. I was gonna say, well, wait a minute. No, 100 sessions under your belt. That's terrific. Thank you for educating our Barchart audience. I really appreciate it.
You for all that you do for me. So enough thanking each other. You ready to get started?
Yes, let's get going.
Okay, cool. So a reminder that today is for educational purposes only, and it's really important that for today's session that you understand that I'm not a professional advisor. And my goal today is to relate to you my experiences and what probabilities might occur. And this is not an endorsement to buy, sell, hold any particular securities. That should be done on the advice of a qualified financial professional. And that under no circumstances shall we be liable for any losses or damages that you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on the information or material that you will receive in this session or through barchart.com and or our services. Okay. With that being said, let's get. So what are some of the trends for 2023? So first and foremost, what trends did we discover from last year? And that, I think, has to be don't fight the Fed. Because 3 times last year, the market fought the Fed, right? And then 3 times, Chairman Powell smacked the market across the head. Again, let's go back to our NASDAQ. And you can remember we had these bear market rallies that we had 3 of them throughout the year. And every time the market looked like it was poised to break out or make a new uptrend, Chairman Powell came out and smacked us silly, basically. And what has Chairman Powell said? I think it's very clear. He says that they're committed to lower inflation and that they will hold rates higher and longer than the market's current perception. So what does this really mean for us as traders? Well, I think it's simple. The continuation of value over growth. And regardless of what happens with inflation data, higher rates are here to stay for the time being. So what should we expect in terms of inflation, recession, and stagflation? Well, just, again, what is inflation? Well, in general terms, that's where prices rise. And we think about this in terms of buying power or units of currencies, buy fewer goods and services. And this usually reflects a reduction in that purchasing power. So that's kind of what you want to think about in terms of inflation. In recession is a business cycle of contraction. And then generally we see a slowdown of economic activity. So macro indicators like GDP, investment spending, capacity utilization, household income, profits, and inflation typically falls during recessionary periods. Now, stagflation is a situation in which inflation remains high as the economic rate slows and unemployment rises as well. So stagflation presents a very difficult dilemma for policymakers since the actions that are designed to, let's say, lower inflation may exacerbate unemployment and vice versa. So I think these are things that we need to be aware of moving forward in this coming year. And so from my perspective, I think this is exactly where our current market conditions are. Inflation is having an effect on spending, which in turn is pushing away many segments in the economy towards recession. And this contraction is changing the way investors perceive market opportunities. Now, the worst case scenario would be stagflation, where both inflation stays high, but the economy contracts. So if this were the case, there would be very few places for us to hide. But I will show you that it's not all gloom and doom. But not only are investors changing their spending habits, but so are consumers. So I think a trend that is developing this year is that there is this behavioral change in consumers. Now, one of my tenets of investing that I learned from Peter Lynch was that trade what you know. In other words, trust what you see around you or how you are reacting to, say, economic changes that are happening to your lifestyle. And to me, it's been very obvious that the consumers are becoming more frugal. So let me give you a case in point. In my town, we had 3 grocery stores, one high-end grocery store and 2 national chains, what I consider mid-level kind of grocery store chains. And Aldi's, which is more of a discount grocery store, opened up about 6 months ago. And it was really amazing. They actually built this Aldi's right next to this high-end grocery store, literally right next to each other to survive. But in 6 months' time, I noticed that the parking lot in the high-end grocery store was getting empty, and Aldi's was getting fuller. And even my own wife uses Aldi's now as her go-to shopping starting point. In other words, she goes to Aldi's first before she goes to any of the other grocery stores if she's looking for something in particular. So I think these economic changes based on consumer spending are starting to have an impact on the economy. Another trend that we can talk about is the dollar. And last year, we saw this parabolic rise in the dollar, and this was a major headwind for equities. Remember that 60% of the profits in the S&P are derived from overseas. And so this decreases the purchasing power, inflation, of our foreign currencies or, potential earnings outside of the US. But the dollar also has an effect on hard assets, for instance, like commodities. And since the peak of the dollar, we also saw a peak of crude oil prices backing off since the beginning of the summer. But the Fed has hinted to us that after the next couple rate hikes, they will hold rates steady. And I think this will give other central banks the opportunity to catch up with the Fed by raising their rates. And so I believe that this trend, the dollar trend, has run its course. Now, should the dollar remain stable, that will be good for us. But for equities, I think we actually want to kind of see the dollar slightly weaken. But a stable dollar, I think, is better than a dollar that is rising. And if the dollar does start to rise again, then this could amplify the bear that is already in place. But as far as global markets are concerned, this could mean that there are some opportunities outside of the US. So, for instance, this is the 50, this is the Indian ETF. And you can see that, on a weekly basis, here's a 3-year chart. It recently has just come off of its highs, but it's been in a nice uptrend for quite some time. Now, I don't know if you knew this, but according to many world organizations, India at some time by the mid-year this year, population will bypass China. So this could be a catalyst, or this is a catalyst for future growth in India. And so there still might be some opportunities outside of the US. For instance, here's a chart of an ETF that is of global markets minus US markets. And even this one, if you look at this one, you can kind of see it has broken that downtrend. Now, it's at an area of resistance right now, but again, there might be some opportunities as investors for us to start thinking outside of the US. But for today's session, we're going to concentrate solely on US equities. I just wanted to kind of show you that there might be some other opportunities developing in the long run. And then the one trend that I definitely have seen is this flight to quality, as investors are signaling to us that their spending or how they are investing has changed, and that has changed from from looking for quality over opportunity. In other words, again, value over growth. Now, let's talk about this in a second. We'll talk about what a safe haven is, but for sure, definitely blue chip stocks have been one of the better sectors or indexes, and this is a trend I think that will continue. But as an investor, a long-term investor, I think a well-balanced portfolio needs to have a mix between equities and fixed assets. And one of the things that we haven't had the opportunity over many years is the returns that we would get on fixed assets, and that has changed. So I think there's competition on equities based on fixed assets. Again, and we're going to just concentrate on equities, but I still think balanced portfolio moving forward in this year, in a very difficult year, might do better if we have a little bit more of some fixed assets. But let's go back to the charts. And again, here's NASDAQ, where we see, this black line represents the 200-day moving average, and the blue line represents the 50-day moving average. And you can see that it's very clear to us that this market has been in a downtrend. But if we look at the Dow Jones, the 30 stocks that are in the Dow Jones, we see a much different picture, don't we? And this is that recognition that investors are now voting with their dollars and looking for quality and giving up opportunity. In other words, growth. So, this, is a much different picture. We see an upsloping 50-day moving average. We see prices above both these moving averages. And the 200-day moving average, although slightly trending lower, looks like it's flattening. So I think this is the trend that is going to play out for this year. Now, eventually, at some point, growth will be more desirable, and I don't know when that will be. Maybe it might be in the second half of 2023. Maybe it'll be not until 2024. But all I can do is listen to what the market is telling me, and the market is telling me quality over opportunity. And finally, volatility. As I had mentioned before, I think volatility is going to be with us this year, and I think it's going to remain with us throughout this year because of uncertainty, because of all the things that are out there, be it geopolitical, be it here domestically, be it what are interest rates going to do to the economy, and how is the consumer going to react to that. But as a trader, I think what we have to think about is we might want to start thinking about shortening our timelines. So for instance, if I'm a buy and hold trader, where I'm looking for opportunities where I'm going to try to gather growth over the next maybe 2 or 3 years, maybe I want to be a little bit shorter term. Maybe I'm going to say, hey, let's see what happens on a 6-month basis, or maybe a 3-month basis, before I start making a larger commitment to the market. As swing traders, maybe we look at timelines of, let's say, a week or so, right? But also, I think this gives us an opportunity to start talking about volatility in terms of options. And I think that there will be a lot of opportunities for options traders and those of us who understand options. For instance, selling covered calls of stocks that are in our portfolios. If I can generate 1% income on my covered calls on a monthly basis, over a course of a year, that would be a 10 to 12% increase in my portfolio based on the stocks that are in my portfolio. So I think volatility is definitely something that we have to keep in mind. And again, here's a great chart. This is the volatility index, or the VIX. You're very common with it. You can see that this year we've had a lot of major swings in the VIX from up and down, and we've been ranging between this 20 and 32 range. Now, one of the things that we've talked about in past sessions is that when it gets above 32, that's usually a buying opportunity, and when it gets down around 20, that's usually, if we look at if you line this up with the times of the market, that was usually a selling opportunity. But the blue line down here is really is a 9-day exponential moving average. And the point I want to make out is that, we see volatility, market is going up and down. The volatility is going up and down. And we don't have to go back very far in the past to see that the VIX in that moving average was well below 20. And that when we got above 20, that was actually an elevated VIX. This is looking back, about, 10 years. So the point being is, I do think that going forward this year, we're going to see volatility continue. And so as an investor, you need to be aware of that, and that why I think you need to be thinking about shorter time frames and being more realistic about the goals that you want to achieve, right? Take the money and run. Always thinking about being closing, looking for those opportunities to, lock in profits or take money out of the market. Don't get married to a position that goes against you, right? Because of volatility. And don't stay in a trade too long. That's why I'm thinking shorter term timeline horizons, because the market could change on a dime. So we can talk about the economic cycle, where we are in the economic cycle. Now, sector performance based on economic cycle is difficult to determine, which sector is going to outperform the stock market. Now, in the S&P, during recessionary environment or a rising interest rate, this is something that could be difficult to do because the performance of each sector can be influenced by a variety of factors. But in general, however, some sectors may actually be resistant to economic downturns and may potentially perform better in a recessionary environment. In other words, we'll look for clues to the flow of money, and the greatest clue that I just showed you was the difference between the NASDAQ and the Dow. But what are the economic cycles? Well, we have the early recovery. This is where the market is starting to rise. It usually comes after recession. We can start looking at technology, materials, industrials. Full recovery, energies, consumer staples, consumer services. Early recession. This, again, I think this is kind of where we're at right now. Economic activity has already surged or peaked, and corporations start warning us of headwinds and slowing growth. Certainly the headlines that we've been seeing in many of our corporations in their earnings reports. So healthcare, utilities, financial services, and high dividend yielding stocks. And then at full recession, economic activity has bottomed, profits have declined, and then there's this anticipation of a recovery. And that would be when we want to start looking at our consumer discretionaries, information technology, and our semi sectors. So that brings us to this chart. And so this chart really looks at, there's two aspects. There's the market cycle and there's the economic cycle. The market cycle here is represented by the black line, the economic cycle represented by the gray line. And what you'll notice here is that the market cycle tends to be in advance of the economic cycle. And typically that's about 6 to 9 months. But if we look where we are in the economic cycle and the market cycle, I think we can agree that we're in a bear market and we're certainly in early recession. So what are the sectors that we're going to concentrate on? Well, we're moving from staples to services to utilities to potential financials. Now, as our market bottoms and conditions change, economic conditions change from full recession, well, then we can start thinking about our cyclicals, our technologies, and our industrials. But I don't believe that we're there yet. I still think that the market is still in this bear market early recession cycle. So there's another aspect we need to take in consideration. As I hinted before, in recessionary times, we tend to see interest rates or inflation fall. But we're not seeing that this time around because there's this element of the Fed. And there has been studies done in this paper, Sector Rotation Monetary Conditions, done by the Conover Group in the Journal of Investment, that during monetary tightening, that these are the sectors that we want to start concentrating, our non-cyclicals, our consumer goods, our staples, our non-cyclical services, healthcare, insurance, utility. So these are some more clues that we can start adding to trends that we're going to start looking for. And certainly these are some of the sectors, if we looked inside of the stock market, these are the sectors that have starting to outperform the market. So again, I just wanted to, let's just do this quickly here. Market rotation or sector rotation. What is a healthcare stock? Well, these are ones that tend to be less sensitive to economic downturns. People still need to have medical, right, regardless of the state of the economy. Consumer staples. Again, I think we want to look for those companies that are selling those goods that people are not going to change their spending habits that much, such as food or household items or personal health care. Utilities. Again, utilities are companies that tend to have stable and predictable cash flow, and they make them less vulnerable to economic downturns. And telecommunications, right? We all need our telephone. We all use the internet, cable or our device you use. How do you get information from the world or entertainment? So these are the sectors or the companies that we kind of want to start looking for. But there are other ways that we can look for opportunities outside of, for instance, these sectors. And so in generating alpha in a bear market, we want to start thinking about income over capital appreciation. What we don't want to worry about is the effects of the bear market. So, in other words, we might want to start looking for stocks that have less sensitivity to the over greater market, something called beta. But we also want to look for those that are going to create income for us. Now, income can come from different ways. I mentioned one way we can derive income in a high volatility market is through options. Again, selling cover calls in those positions that are in our portfolio. But one of the easiest ways to create income in our portfolio is dividends. And there are something called the dividend aristocrats. Now, if you don't know what the dividends aristocrats are, well, these are companies that have increased their dividends for the last 25 years. And just to name a few for you, I have a list here. Let me just read it to you. J&J, Procter & Gamble, Pepsi, IBM, McDonald's, Walgreens, Coca-Cola, Conoco, Abbott Labs, Medtronic, Hormel, Microsoft, Kimberly-Clark, Emerson, Caterpillar, and 3M. So those, I think, will be some of the higher quality stocks that the market will move in. And then I guess, again, if you would look at those ones I just mentioned, you'll see that they are the ones that have been outperforming. But again, we don't need to focus just on that group of, let's say, 10 or 15 of aristocrats. We could look at stocks that have given a dividends growth, let's say, over the last 5 years, or that their dividend is one of the better dividends among their peers in one of these sectors that we're going to concentrate on that are going to outperform in what we have determined might be difficult economic times. So how do we delineate between those different companies? Well, we could talk about our balance sheet. Let's concentrate on those companies that have low debt to equity and also are using that opportunity to increase their shareholders' equity. Again, equity growth, quality earnings, strong cash flows. Again, some of our consumer staples are typical of these types of companies. What are they doing with their cash flows? Are they outperforming the market? Is their cash flows rising in these difficult times? And do they have stable margins? In other words, are their costs relatively low or not rising? And what is their profit margins in terms of the dollars investment and the return to us as investors? Excuse me. And then capital expenditures. Again, I think this is a little bit counterintuitive, but in a defensive market where we're going to go this year with uncertainty, I'm going to look at those low CapEx companies, those that are not spending exorbitantly, not adding a lot of new debt to their balance sheet, and maybe those that are using their positive cash flows to buy back stocks. If you think about the oil patch, one of the reasons why the oil sector has done so well, even in the light of oil prices falling over, let's say, the last 6 months, is because a lot of these integrated oil companies don't have a large CapEx expenditure budget. They've been holding their cash and they've been using it to pay dividends and do share buybacks. So, these are the type of companies that are going to hold up in these more difficult times. So now we have a basket. First of all, we have a game plan, right? We know where we are in the economic cycle. We know what sectors we're going to think about, and then we have these criteria that we're going to do to kind of just delineate between the different stocks that we're going to discover. So let's do that. So let me go to, first of all, let's go to our stock screener and let's start there. And I think this is one of our most powerful tools that is on our website. So the first thing we said is, well, we're going to look for quality, right? These blue chip stocks. So let's eliminate, the small caps and the over the counter. Maybe we can eliminate NASDAQ, but let's leave NASDAQ in there for now. But, just kind of the blue chip stocks. So let's start there. And then from there, I'm going to start adding some other filters. Now, the first filter I'm going to do is I'm going to go into the sector index groups. And we know what index groups were said that we want to look at. We want to look at consumer staples, healthcare, utilities. And I could add some of the other Dows, since the Dow has been one of the best performing. Let's just make it simple. Let's make it Dow utilities. So that would be my first. That's the basket I'm going to draw from. That's going to be my jumping off point. So what was something else that we said we could look at? Well, we said dividend yields. So let's look at annual dividend yields. And again, where do we start in this? Well, let's make the bar a little bit high. What was another aspect or matrix that we were thinking about? Well, we said we could think about cash flows, right? We want to see our companies who are having a positive cash flow. So let's look at cash flow growth, and we'll look on a quarterly basis. We want to see those that are doing well now, right, as things are getting bad out there or potentially getting bad. So let's see those that have cash growth in, let's say, the last quarter. And again, let's raise the bar up, good to high. And then, I'm just going to make this very simple. I'm going to add one more element. Now, I've given you two fundamental elements, so let's do one technical element. And so you might not be aware of this, but down here where it says found on list, if I go into that, we have found on list, it's called trading signals. I'm going to add that as well. Now, what signal I'm going to look for? Well, I'm going to look for something that's called stock signal upgrades. Now, what does this mean? Well, in any of the stocks that we have or any of the ETFs you have, you can find over here something called the Barchart opinion. And the Barchart opinion breaks down the stock, or in this case, the Dow Jones, and it looks at 13 different technical indicators, and it assigns a common interpretation. Either it's a buy or a sell signal. What we're doing by adding that signal, that upgrade signals, we're looking for those stocks whose majority of these technical indicators were once sells and are now turned buys, or once buys and then turned sells. But we're going to look for those buys, those ones that these short-term, intermediate, and long-term indicators are now, a majority of them are giving us upgrades. In other words, we've moved from sell to buy. And so if I do that, again, very simple filter here, I get about 60 stocks. So at this point now, I can start doing some of those other aspects of my selections of those particular stocks. Now, you do see that there are a lot of energies and utility companies in here, but there are some consumer staples. I do see, food companies, even some real estate companies snuck in there. So what are some of the aspects that we said that we could talk about? Well, I might go to performance, right? Let's see who the top performance over, let's say, the last 3 months. Now, Kraft Heinz is definitely one of the ones that has performed well. So what I might do is now I will take that opportunity to look at some of those metrics, right? Let's, for instance, what is the dividend yield, right? Nice dividend yield. But what is the earnings growth, or the earnings growth from quarter to quarter? Not so great. Maybe I'll look at, the profit margin. Again, this is not a glamorous stock, right? But maybe I can find better profit margin. Maybe I'll look at price earnings, right? Very low price earnings. That might be a good metrics for me. But I could also look at things like beta or my debt to equity. Again, so there's some positives in this particular case, and there are some negatives in this particular case. And what I might do now is I'll come over here in links, and I'm going to add it to a watch list. And what I did was I've gone through a lot of these different stocks, and I created a couple different watch lists. And so maybe I might add this one to my one that has positive cash flow, if that was the case, or it had a good dividend, might add it to that watch list. And then later I'll go inside of that watch list and then boil it down until eventually I might get just a few handful of stocks. So what are some other ways that we can kind of boil down some trading opportunities? Another way is we can come down here where it says sectors, and we can look at industry rankings. Again, now we know what sectors that we're looking for, and these are ranked by their weighted alpha. How well have they performed over the last year, with a greater importance in most recent months. And again, look at here, we see that one of the better industry group rankings is our large cap pharma. And so if I go there, these are our large cap pharmas. So again, I could do it based on performance, right? Which one has the top performance? And you can see Merck rises to the top. Which ones might have other aspects? Now, under custom views, these were custom views that we can create on our own. If you're interested in learning how to do custom views, we have some webinars about that, or you can reach out to our support. So I have, like, for instance, fundamentals. What are my earnings growth? What is my PE forward, net income? There's my cash flow, right? There's my beta, right? How I want to find those stocks that have less sensitivity to the stock market. If a stock has a beta of 1, it's equal to, let's say, the S&P. Anything less than, it's less sensitive. So in a downturn market, those that have lower betas are not going to fall as bad. But there's a giveaway too, right? So if the market does turn up, these ones will be slow to rise. So, but in a defensive market, we're going to probably anticipate for the next 6 months, these lower beta stocks might be the ones that are going to outperform in the longer run. And eventually, at some point, we'll start looking for higher beta stocks when economic conditions change, but that is not yet. And then we could do this again by sort by dividends. Again, I do some other comparatives. What sector, what industry, again, P ratios. How far are we from our 52-week low or 52-week high? That might be one of the telling points. For instance, Merck, it's right near its 52-week highs. This is a stock that has performing well. I like to buy stocks that are relatively stronger than other stocks. Maybe some of these ones that are farther away might create trading opportunities, but there's a reason why they're on their lows and not on their highs. Another aspect of trying to find those stocks that are doing well, we can come to our industry heat map. And this is another great way to really dial in or be more granular on the different sectors that we want to look. So let's look at those that have outperformed. Again, oil's been one of the better ones, but there are other ones that are starting to pop up. Gold miners, like cosmetics, paper products, food and miscellaneous. Again, our consumer staples. Again, I can open that up, and there's are those stocks that are inside of that sector. Again, I can view these in terms of performance, right? Which one is the best performer over the last 3 months, over the last month? Which ones have good fundamentals? And then maybe I'll start, looking at the charts, right? Maybe I'll start looking for those that look like the chart is rallying. For instance, I know this Lamb and Weston, right? That's a nice looking chart, right? I like buying strong charts. General Mills, again, another chart that looks very strong. And again, at this point, I might add this to a watch list, or I could come into my data field and say, okay, well, what is my yield? What are my profit margins? What is my price to earnings ratio? What is my debt to equity? And then I say, okay, yeah, this is one that I want to do a little bit more deeper intel. And so, maybe I'll add it to, my watch list idea. Okay. So again, I'm not endorsing these stocks, the ones that I'm going to show you in this next segment. But what I want you to understand is this is how we do the process. We gather these stocks, we put them in the basket, we wait for the opportunities, we use our risk management, we wait for those times when the market gives us an opportunity to get back into these stocks, or we wait for breakouts, pullbacks, depending on how you look at the market. But what I'm trying to do is I'm trying to find the best of the best based on these different criteria, and based on the different sectors and industry groups that I believe are going to outperform. So that's what I did. I created this watch list of, some, hang on. I went through all the different industry groups. I picked out the best of the best. I started doing all of that, those matrices, and I got like 70 or so stocks, a lot of different stocks. And then I whittled it down to these 23 stocks for the year 23. And again, I'm not endorsing these ones. I'm just showing you the process. Now, full disclosure, there are 2 on this list that are part of my current portfolio, and that is CEF which is a precious metal trust, and ADM, Archer Daniels Midland. But any of you have been in many of my sessions know that Archer Daniels is one of the stocks that I have continually had in my portfolio for a long period of time. So again, what I'm trying to do here is show you how to listen to the market, and I'm showing you how I'm drawing upon my experiences and relying on those time-tested probabilities of what sectors can look. So before we break these down and look for a couple examples, I do see some of questions that have popped up. So James, give me a moment here. I want to read some of these questions, okay?
So while John is reviewing his questions, I just want to remind everybody that you are going to get a link later on via email to the webinar recording. We record every webinar that we do, and we have a webinar archive page that you'll be able to find this on, along with all of John's slides from today. We also post everything on our YouTube channel. Barchart has a great YouTube channel where you can watch all of our archive videos. So that's one question that everybody keeps on asking is, can they watch this thing again?
Yeah, and also I just wanted to let you know that the slides that I've gone through, they will be attached to the session as well, so you can come back and review those slides as we go deeper into our discussion here. So there's a question here from Richard about seasonality. You know, again, Richard, I'm really not concentrating on those micro kind of events, seasonalities, although I think that is something that we need to address. If you want to know about our seasonality, that there is something called a January effect, and that usually what happens in the month of January leads to what happens to the greater year. So that, I mean, that is something I'm definitely going to watch. There's a question here about what's the difference between recession and stagflation. Again, the difference is that recession is we have a contracting market, contracting economics, and usually in a recessionary time, inflation, we have a de-inflation, right? Inflation comes down. In stagflation, it's just the opposite. Inflation remains high, and actually sometimes it actually goes higher. So that's the main difference. And really, again, I want to reiterate, when you're in a stagflation market, there's really no place to hide. Equities do not perform well, no matter which ones that you are in. There's a question here from Ted about central banks tightening too slowly and exhibiting persistent high inflation. Is this really an investment return? No, it's not. It isn't, right? Because right, you could lose the value, currency value could decrease based on the inflation, right? The point, what I'm saying is that if our Fed holds rates constant once they reach their target goal, then the other currency central banks that have been behind the Fed will start catching up. And that might shift that kind of currency pendulum, and that might create opportunities. The example I gave you with India was there is growth in some places of the world, maybe not necessarily in the large economies, U.S., Europe, or Japan, but there is growth around the world. And one of the places where we are seeing growth is in India. And why is that? Well, India's population is growing, so there might be opportunities outside of the U.S. To invest in those emerging markets. Steve asked a question about VIX. Steve, we've done a couple webinars about the VIX. We go into a lot of detail of that. So I refer to you is to check out those couple of those videos. And let's see, what do we got? One more question here. One about Richard is asking about the difference about considering the importance of Ukraine, COVID, and these other black swan events. Again, Richard, that's why I was saying is I think, as in terms of an investor, I think this is going to be a very, very difficult year for us because of the uncertainty of a lot of these different markets. Okay, so here's my watch list, and some of the ones, again, let me kind of just filter this one. Again, some very general categories: utilities, uh, which ones, why I like some of these. I mean, I was just kind of looking at, I wanted to see a relatively low PE ratio. I wanted to make sure their prices hadn't gotten too far away. I wanted to make sure that they have a good dividend. They want to see if they have good cash flow. And so that's how I kind of broke this down. TJ Maxx, I know, this is a retail company, but again, Peter Lynch, observe what you see around you. And, on Sundays or Saturdays when I'm out with my wife, this is one of the stores that she goes to, right? I mean, and we're in that store, the store is busy, right? So, this is a discounter, right? Changing consumer behaviors. Well, energies. Now, I think that if we get into a recessionary cycle, then energies will be one of the sectors that will underperform. And that is a classic example. But why I'm still holding on to some energy sectors or stocks that are in the energy sectors is I'm kind of hedging my bet a little bit here. If inflation holds steady, then I think that there are some of the energy sector stocks that will do well. I really kind of like these MLP, Master Limited Partnerships, but this Permian Basin represents a patch of oil patch in the Southwest, which is a premium type crude, sweet crude, WTI, West Texas Intermediate. And, I just think that in the long run, this is a sector, this is an area of the oil patch that is going to continue to do well. Valero, the reason why, I mean, this one, if we break this one down, you'll see that it has a very high beta. But again, look at the PE ratio forward, and this is a company that is generating a lot of cash. Yes, it does have a large debt to equity ratio, but it costs a lot of money to run one of these refiners.
John, can I
Yes.
interrupt for just a moment? We
Yeah,
have
go ahead.
so many people asking where they can get a copy of your watch list, this 23 for 2023. And this is actually part of the investing tab right there, 23 stocks for 23. So for everybody who wants to kind of follow along on their own screen with all these stocks that John is showing you from their watch list, from his watch list, they're on the site for you already. Okay.
All right, Gene. Thanks. I forgot to look that up. I did. Great job, Gene, getting
They're
that up.
there.
They're
Yeah,
there. Yeah,
they're there.
they're there. Okay. So in terms of Valero, there's just a limited amount of refining capacity in the world, and definitely here in the U.S. And if oil prices fall, remember that's the input costs for refiners. And in recessionary times, gasoline demand, diesel demand, you might see it fall a little bit, but it really is inelastic. And one of the mega trends that I think that is going to occur this year that we haven't really talked about post-COVID is there's a lot of companies that are now telling their employees that they need to come back to the office, maybe not every day of the week, but 2 or 3 times a week. And I know my 2 daughters, one of my daughter's company is mandating that people need to come back to the office. So that's going to mean more commuting, right? More energy consumption. So that's why I kind of, even though I think Valero might be subjective or might get pulled down by a recessionary as the oil patch itself maybe takes a little bit of hit, I still think that in the long run, this is one of those stocks that will hold value, throughout the year, especially if we get a turnaround in the economy. Again, look at some of the medical ones. I stuck with, a couple of large cap, and then, more of a disposable, outpatient type care. Quest, blood results. I'm sure everybody's aware. You heard that COVID cases are up. So I think, this is a kind of stock that has performed well in the past, and will, I think it's DGX, there it is. It's performed well in the past during, the last COVID run. And, it did have a little bit of a correction. And again, like I said, I like stocks that, I like charts that look good. And this, to me, it looks good to me. So, I know I'm running out of time here, but I do want to, again, kind of talk about a few of these consumer staples. Notice how I balance this out, not only from food, but tobacco. So, again, in recessionary times, two industries that do very well are tobacco and alcohol. People smoke and drink when they're nervous and upset about the economy. That's one of the facts. Now, why wouldn't I pick, let's say, Philip Morris over Altria Group? Well, if I go into the profile of this company, not only are they in the tobacco business, but they do own Philip Morris. So you get the Philip Morris position, but also notice that they also have an equity interest in Anheuser-Busch and a Canadian cannabis company, in case, we get some changes in some of the rules here, laws in the United States. So I think this is a company is well positioned based on the tobacco and alcohol. And, again, you get a nice dividend here, 8% dividend. And, if we look at, profit margin in terms, and again, very low PE ratio stock. So this is not one that I'm not too concerned about falling, and I'm going to get that nice dividend. And then down here at the bottom, I did add some of those stocks that we can start thinking about in case we do start seeing a change in economic activity, or do we see a bottoming? Let's say we get a soft landing. Now, I don't think those things are going to happen until we get some criteria. I'm going to show you those in a second. But, Rogers Communications just went through a merger. They basically now have a monopoly in Canada. This credit card company is helping create, credit card. A lot of consumers are adding more credit card debt. And how do they add more credit card debt? They open new credit card accounts. I did do Visa, so I'm doing a little bit of crossover there. Aerospace, again, maybe not a typical defensive stock in the terms of low beta, but this is a defense stock. And I looked at the sector in terms of the aerospace group, and you got Lockheed Martin, Raytheon, and this one just to me looked like it had a little bit better balance sheet. And finally, the last one I wanted to kind of just do quickly here is I'm going to play that inflation hedge. I'm going to say that inflation is going to continue and that the dollar will weaken. So I do believe that in the short run, there will be some opportunities in gold and silver. Now, I couldn't make my mind up about which one to pick, gold or silver. So this is a trust that does appreciate based on the gold, the actual physical gold or silver that they have in their possession. So this is definitely a nice chart. And when I'm interested, what I'm not going to do in terms of gold ETFs or any of these other commodity ETFs, I'm going to stay away from those that have a little bit more volatility in terms of their pricing is based on the derivatives. In other words, the futures market. This one is based on literally the gold that they have in silver that they have in their vaults. All right. So let's do this. I want to give you one more. Oh, by the way, this is just a screenshot. This is in the slides of, that jumping off point that we looked at to find those different stocks. So let's go to, whoops. How can we determine the next leg and the next economic recovery, right, to the beginning of it? So I think we need to see that stabilization to weakening of the US dollar. That would give me more onus to start looking at some maybe growth stocks. Positive sloping yield curve. So let's go to that real quickly. Here's a 10-year note yield, and then what I've done is I've added a comparison. And the comparison that I added was, an expression. I did the 10-year note minus the 2-year note rate. And you can see that it is down sloping. This is not a good sign for economic activity. And typically when we have what is called an inverted yield curve, when the longer term rates are less than the shorter term rates, below zero, which we are currently in, this is a sign of a recession is going to come. Matter of fact, if we look at the last three recessions, the last five recessions, there's three events that seem to always happen. One is that there's a price shock in the oil market. The other is an inverted yield curve, and I forget what the third is. Monetary policy, right? The Fed tightening. This is the first time we've seen all three of these events happen. So again, I'm not going to be growth oriented in terms of portfolio management until I see this yield curve get above zero. And that still might not be enough to get us into the next leg. We might need another 6 months or 9 months before that growth spurt happens, but it won't happen while we're inverted. Okay. All right. I went a little bit over, Gene, but I think there was some good stuff here. So,
right. You're allowed, John.
Thanks.
Got a lot of good info.
So, again, I just want to remind you all that a lot of the stuff that I showed you, some of the screener aspects, these are premium features that we can, you can join Barchart for a trial period of 30 days. You can try out some of our premium features. And one of the other premium features that I'm kind of proud of right now is on Fridays, we have something called the Market on Close, and this is for our premium members. And what we do is we kind of break down what's going on in the market on a week-to-week basis. We look at some trading opportunities. We talk about these macro events. We look and see how we can apply them to some trading opportunities. And so this is definitely something that I'm very proud of in terms of an added feature that is part of a premium package. Okay. What do we want to do next, Gene? Let's finish up. All right. So next week, not archive, but upcoming. Next week, we're going to look at multiple time frame analysis for better trading entries. What I'm going to do here is we're going to kind of do this top-down analysis, but we're going to use time as our measuring stick. We're going to look at, what is the market doing, or what are these stocks doing in much higher time frames, monthlies and weeklies. Then we'll look for a trend time frame, and then we'll use a lower time frame to look for signals. And I'm going to give you kind of my interpretation from my experience of which analysis tools, which technical analysis tools that I use at the higher time frames and which ones I use at the lower time frames to find these opportunities. So I would encourage you to join me, and I think you'll really enjoy this one. I think there's a lot of powerful information in that one. Okay. All right. I think that's about it, Gene.
I think so, John. Way to start 2023.
Yeah. Wow. Boy, an hour went fast today. Yeah, folks, please. Thank you very much. I'm honored that we have reached this 100 episode mark, and I'm looking forward to having a great year this year. And we have a lot of interesting subject matters that are going to present to you guys this year. So until next time, best of health, be safe out there, and the good of all trading.